Hi everybody. This will be our makeup lecture regarding Chapter 17. As you recall, a few weeks ago now we started talking about uh, where to find debt and the legal ramifications of debt and the legal contracts regarding debt. Uh, Starting today, or starting with this chapter, I should say, we're going to focus on sources of potential equity capital. The combination of debt and equity used to finance any real estate transaction is referred to as the capital stack. Pretty simple on where you could find sources of debt capital. You could just go to any local bank and ask them for a commercial loan. Finding equity is a little bit more difficult. We discussed a few places where to raise some debt, or I'm sorry, to raise some equity capital for projects. And the first place anyone should start is really with friends and family. We also discussed some other aspects that we'll talk about in a little bit more detail in Chapter 17, especially the legal and tax ramifications surrounding any sort of equity raise. Because real estate or most real estate transactions tend to be larger in size, most investors cannot afford to purchase commercial real estate on their own. A typical form of raising enough equity or raising enough funds to purchase real estate, which has gone back to the origins of the real estate market in this country and in other countries, has been to pool capital from many or a few individuals. This process is also known as syndication. Syndication relates to slicing up a deal, much like the syndication of commercial mortgage-backed or mortgage-backed securities is slicing up a loan or slicing up a pool of loans and selling them to individual investors. The process of syndication or syndicating equity in a real estate transaction is slicing up the ownership percentages to individual investors, which opens up uh, the possibility of commercial real estate ownership for people that may not have the funds to buy it individually. Now, this syndication structure can take many forms, some of which you may have heard of, some of which you may have or will learn about when you take real estate accounting and transaction. And those are general partnerships, limited partnerships, corporations, both C and S forms, LLCs or limited liability companies, tenancies in common, which we talked about when we talked earlier in the semester, and real estate investment trust, or REITs for short. We will talk about some of the pros and cons of each of these forms of pooled equity ownership in part one. So you pool equity, you may need $1 million to purchase a building. You only have a couple hundred thousand, but you know a few friends that also have a couple $100,000, and between you and your friends, you could raise the amount of equity that's needed. So one of the major advantages of pooling equity is it allows investors to purchase an interest in larger properties. These larger properties or more expensive properties would be somewhat out of reach for each investor individually, but by pooling capital, they're able to get a percentage of a $30 million building, some percentage of a $30 million building, as opposed to having 100% of a $5 million building. What this allows investors to do is to diversify their portfolio. They may be able to put money in multiple different property types or multiple properties of different property types, thus shielding themselves to any market downturn or potential market downturns in any specific asset. What pooling of equity also allows to do is allows investors to create economies of scales in acquisitions, management, and dispositions collectively known together as asset management. Larger properties are easier to manage than smaller properties. For example, if you have a superintendent of a building or a project manager that is in charge of 50 units, they could go to 5, 10 unit buildings, which can be time consuming to split their time amongst multiple different buildings, the commuting time, things of that nature, as opposed to buying one 50-unit building. The larger the loan, the cheaper the debt capital can become because it opens the buyer up to a larger pool of lenders, i.e. your conduit or your CMBS lenders like insurance companies and pension funds. And another advantage could be the expertise of a management team that's hired by the syndicator or the organizer. When you put a syndicate together, the person that is going out and raising the funds is referred to as the sponsor or the syndicator organizer. In common terms, though, they are really just referred to as the former verbiage or the sponsor. The sponsor, because this is a larger building or he's doing more than one deal, would then have, in terms of management fees coming in, enough funds to hire a team of professionals to manage the buildings. A well-managed building could increase rents or allow for the landlords to increase rents and to drive up net operating income, as if you remember back to our chapters on appraisals, a higher NOI can work to increase the value of investment properties. With any advantage comes a disadvantage, and some of the disadvantages related to pooling equity is that the syndicator or the sponsor must relinquish management control, or say the investor must relinquish management control to the active manager, usually the sponsor or the general partner. The investors usually compensate the syndicator or sponsor with some sort of fees, salary, or disproportionate share of equity ownership. And the reason they do that is because without this sponsor of the deal, they wouldn't be making the returns that they are. Their money just might be sitting in a savings account earning almost nothing. The process of handing over a larger share of the profits to the plan sponsor is referred to as a promote structure. A promote structure, or a promote in the industry, is just where a sponsor of a deal may put in 5% of the equity but receives 10% of the profits. It's just a disproportionate ratio of returns based on the amount of monies put in at the beginning of the deal. So with all else being equal, a promote structure lowers the equity returns to the investors but increases the returns to the plan sponsor. When you pool equity together, you have a number of different choices in which to buy or purchase the property and hold it under. Some of the choices that drive a specific ownership form are mostly related to financial reasons, and the largest reason or the largest deciding factor driving ownership forms is federal income tax issues or rules. Additionally, the desire for investors to have limited liability also is a factor in choosing a specific ownership structure. Other drivers in the choice are management control issues, ability to access debt and equity, ability to share risk with other investors, and the ability of investors to dispose of their interest. Keep in mind that each type of ownership form has their own specific issues or own specific issues of their own relating to one of these six areas or six drivers of ownership choice. And we'll now look at each of these specific type of ownership choices, their pros and cons individually. The oldest form of syndication or ownership form relating to syndication is that of a general partnership. A general partnership is just your basic run-of-the-mill partnership. It is treated as a conduit for tax purposes, meaning all of the income from the investment in the building is passed on to the members of the partnership and taxed at their individual tax rates. In a general partnership, investors avoid double taxation because there is no taxation at the partnership level, only at the individual member level. In a general partnership, all partners can make operating decisions, and they each, unless specifically outlined in an operating agreement, each of the members can make decisions that bind all of the other members in the general partnership. This is actually looked at as a major disadvantage. The lack of separation between ownership and control may lessen potential conflicts of interest, but each partner will have a specific idea of how to handle a certain situation, and which, if each of those partners or none of those partners could come to a meeting of the minds, it could relate or it could result in gridlock in the decision-making process. As with anything in terms of decision-making, percentage of cash flows and profits, and whatever management and tax consequences related to that should all be spelled out by a partnership agreement. And within a partnership agreement, special allocations are permitted. This is a joint document or a document that is agreed upon jointly, and all partners need to sign it for it to be effective. Some of the major disadvantages, other than what we just spoke about, is that the general partners are liable for all debts of the business. As we said just a few seconds ago or a few minutes ago, each partner is liable for the debts of the partnership, whether they agree to it or not. Additionally, all of the personal assets of the general partners are also open or subject to claims of the partnership's creditors. Because of these disadvantages, general partnerships have fallen out of favor in the past, I should say, 15, 20 years, and have been eclipsed by other forms of ownership. Another form of partnership is referred to as a limited partnership. In a limited partnership, there are two partners, or I should say two entities that could consist of numerous individuals as partners. These two types of partners are a general partner and a limited partner. Now you need to distinguish between a general partnership and a general partner in a limited partnership. The general partner, or GP, is the person who organizes the venture and is usually a knowledgeable builder, broker, or investor. A general partner would be referred to as the sponsor or the syndicator. Limited partnerships have the same flow-through taxation treatment as general partnerships. So all of the income of the partnership would then flow through to the general partner and the limited partner, and each member is taxed based on their individual tax rates. In a general partnership, there is limited liability for LPs. Your LPs, or your limited partners, are normally referred to as your silent partners. They normally do not have any say in the ongoing day-to-day business management or operations of the building. They may have a say in major decisions such as a refinance or when to sell, but they won't have any part in decisions on whether to paint a specific apartment white or to paint it blue. So they are limited in liability because they're not involved in the day-to-day. However, because the general partner is, they have unlimited liability, just like in a general partnership. However, the forms or the ownership structure of the limited and general partners are not limited to individuals. A general partner may be a corporation, an LLC, or any other type of entity form. Those type of entity forms, as we'll learn, can limit their liability. Some disadvantage of a limited partnerships is that LPs, which normally produce the majority of the money, have limited control of management and policy making. Additionally, a principal-agent relationship is created, and all of the problems that come with that will apply. We'll talk more about the theory of principal and agent when we talk about contracts, but just as a small aside, the general partner has a fiduciary or financial responsibility to act in the best interest of the limited partner. Sometimes they may not do that, or they may not think of that. So there are numerous problems associated with that, and then if a limited partner doesn't have any say in the day-to-day control, then those issues can be magnified in terms of building value or with anything that may arise in the future. C corporations is another form of business ownership, and a C corporation is how most large corporations are formed. C corporations operate as their own legal and taxable entity separate from their shareholders. C corporations can buy and hold property, they could take part in transactions, and they are taxed as any other individually would, albeit at different rates. Because they are looked at as a separate entity, any property held or any investment or businesses held as a C corporation are subject to double taxation, meaning that profits are taxed at the property level, and then they would also be taxed as a distribution or a dividend to the individual shareholders of that C corporation. C corporations, because of this, are not a desirable structure of holding property. Most properties that are held under a C Corp type ownership are corporate assets that are held by a company that works and operates out of that building location. S corporations have the same limited liability for shareholders as C corporations, meaning any individual shareholder is only liable for the amount of investment that they put into the entity. So if you only invested $100, your liability is only $100. S corporations also create a separate legal entity, but they are not a separate tax entity, meaning there is no double taxation in an S corp. All of the profits flow through to the individual shareholders and are taxed at their individual tax rates, much like that of a partnership. There are certain rules and regulations regarding S corporations, and you cannot just set up a corporation as an S corporation. You have to inform the state where you're incorporating that you specifically intend to operate as an S corp. And if you do, you can't have no more than 75 shareholders. And each cash flow and taxable income item must be allocated to each shareholder in proportion to his or her ownership of corporations, i.e., there's no special allocations allowed, so that means there's no promote structure possible. The ownership entity or special purpose entity that has been increasing in popularity for real estate transactions is the use of limited liability companies or LLCs. The LLC law was passed about 25 years ago, which allowed small businesses to own assets in a hybrid form that takes the best protections or the best advantages from both a corporation and a partnership structure. LLCs are not a corporation, a partnership, or a sole proprietorship. However, you have the option to choose a partnership or corporation tax status, meaning you could either be taxed with double taxation if you choose the corporation method, or you could do a pass-through method or conduit method if you choose the partnership. Limited liability companies are hybrids. They take the best of both corporations and partnerships. However, they do have some disadvantages associated with them. You must always have an operating agreement in an LLC. That operating agreement will spell out the rules and regulations and policies surrounding the management of the entity. It'll list someone who is a managing member, the person who is responsible for making day-to-day decisions. It will talk about how many votes are needed to make major decisions, so on and so forth. Everything in an LLC, especially in an LLC with multiple members, will require an operating statement. People that invest in an LLC are referred to as the members of the LLC, not partners, not shareholders. And if you have a multiple member LLC, you need to supply a operating agreement for any deal or any contract that you are entering into, such as a loan to purchase the property. Another form of direct co-ownership is the tenancy in common. As we studied earlier this semester, TICs are one of the oldest forms of co-ownership. Essentially, each partner in the deal owns a fee simple interest with each other. Each investor will receive a separate deed and are direct owners. Each investor may hold a different ownership percentage, but otherwise, interests are indistinguishable. In tenants in common, each individual member could sell or mortgage their interest in the property separate from the other fee simple holders. This is a major advantage. However, tenancy in common is limited to 35 or less investors. So you can't structure a building in a TIC ownership with 100 different owners, each person putting in $1,000 or $10,000. That's just not allowed. And from a management perspective, is just not practical. Generally speaking, tenancy in common is a bad form for investing in real estate. It has joint and several liability. But after 2002, this form of ownership gained significant popularity with private investors because of the 1031 exchange rule. 1031 exchange rule is a tax-deferred ruling, which means that when an investor sells a commercial building, they will be charged no federal income taxes if they roll all of the sale proceeds into the purchase of another or multiple properties of equal or greater value. You cannot 1031 an interest, you cannot 1031 the sale proceeds of one building into a membership interest in an LLC, which limits some buyers or some investors to smaller properties. But under a 2002 revenue ruling, it was determined that investors can exchange a 1031 or 1031 funds in real property for a share of or a fee simple deed in a tenancy in common property. Some disadvantages of tenancy in commons are that sponsor fees may consume much of the equity. if you are putting a deal together and you are generating returns for someone or shielding them from federal taxes on the sale of a separate property. Sponsors want to get paid for that. It's like a management fee. There is evidence that TICs overpaid for properties, and they could do that from a strict investment return perspective because they're saving on income taxes on the sale of their other building. Additionally, the more they pay for a property, the more depreciation they have, which means more of the net operating income can flow to investors because of the tax advantages created by a non-cash item such as depreciation. And much with other forms of partnerships and LLCs, co-owners must unanimously approve the hiring of a manager, the sale of a property, all leases, all mortgages and liens. And for other actions, co-owners may agree to be bound by a majority vote. There should be a contract or an agreement set up, just like there would with any partnership or LLC agreements. This concludes part one of the discussion on equity and direct co-ownership or direct and indirect co-ownership of properties. Part two will deal with additional sources of equity from both the public and the private markets.